The central bank rate is just one of the factors that exert pressure on interest rates on loans. It is not a single factor to determine interest rates. Other fundamental economic factors such as rate of performing loans, inflation and other costs of operation together determine the interest on different loan portfolios. Therefore, the reduction of central bank rate does not necessarily mean reduced commercial bank interests on loans. This means that the central bank governor directive to compel the commercial banks to reduce the interest rates in line with trends of central rate is far-fetched.
The commercial banks will now reduce the lending rates.
That there is nobody who is putting pressure on banks to reduce interest rates. It is in the interest of banks. It's in the interest of banks to lend at appropriate interest rates depending on the economic circumstances of the day.
Normally, commercial banks will set the interest rates that they charge on their loan rates above the CBR. This is because their lending rates also cover for the cost of mobilizing funds, administering the loans and possible losses from loan defaulters.
It's very important to encourage our people to repay loans when they borrow. That way, everybody will borrow at much lower rates.
In a liberalized market economy such as Uganda, the commercial banks have some freedom to set interest rates in accordance with market conditions and business costs if the commercial sector is to develop and serve the needs of its customers. High lending rates are often necessary to allow banks to extend credit to risky projects. But the CBR sets a benchmark for interest rates in the economy. If commercial banks claim that the adjustment of interest rate is not only dependent on CBR, why then do they rely on central bank when the CBR is raised? They raise interest rates when CBR is raised, but when it's lowered, they are slow to act. Ultimately, the borrowers are the grass that suffer in this liberalized financial sector. Nada Koza Lydia, NBS Television, Business.